So what's an index fund? An index fund is a mutual fund or an exchange-traded fund, an ETF, whose portfolio of holdings, meaning the stocks or bonds that make up that fund, mimics or tracks the components of a financial market index, such as the Standard & Poor's 500 index, called the S&P 500. So by purchasing shares in an index fund, you're purchasing a little bit of whatever that fund owns. And for an index fund that tracks S&P 500, for example, you would be buying and owning a little bit of all the companies that make up the S&P 500. So you minimize the risk of an individual company doing poorly, because in the mix of S&P 500 companies, you will have other companies that will do well. So what are the most popular indices? There is the S&P 500, which is an index of the 500 largest U.S. publicly traded companies. There's Russell 2000, which was started by the Frank Russell Company in 1984, and it's an index made up of 2,000 small cap companies. And then there's Wilshire 5000 Total Market Index, which is the largest U.S. equities index. This is a broad-based stock market index of publicly traded American corporations. It reflects the entire U.S. stock market. The Wilshire 5000 includes about 3,500 companies now, although it held 5,000 companies when it was first introduced in 1974. By the way, there are also international stock indices and bond indices. So what are some of the advantages of index funds? Diversification and low fees. Index funds help minimize risks by providing diversification. So instead of having all of your eggs in one basket, if you were to invest in one company or just a few companies, through index funds, you can be invested in several hundred or several thousand companies, such that the performance of some of those companies that don't do well will be balanced out by the performance of others that do well. Also, index funds have very low fees. And that's because there's no cost associated with paying a fund manager to actively manage the fund, which would involve spending time to research and identify great performing stocks and then buying and selling them at appropriate times, with the goal of seeing to it that the fund that they are managing performs better than the market. Index funds are passively managed and adjusted to reflect the market index. The bottom line is that you don't need to worry about how your particular stock is performing or how your particular sector is performing if you buy shares in these index funds. You can just sit back and let your investment grow over time, because in the long run, the market will be trending up. I'm not going to mention any specific index fund by name, because I've made it my policy not to talk about any specific investment vehicle by name, because I don't want to be responsible for anyone losing money from buying shares in a specific company or a specific fund or a specific investment product that I recommended. There are many index funds out there that are rated very highly, and if you Google best index funds, you can easily find some great ones. Now, you can purchase index funds that are mutual funds or ETFs. Many folks will tell you that mutual funds have higher expense ratios or fees than ETFs because there's still a fund manager associated with mutual funds, while ETFs do not. That is simply not true. There are mutual funds whose expense ratios are lower than those of ETFs. Since these fees affect your total return, you need to look up and compare the expense ratios for the mutual funds or ETFs that you're interested in. Here are the simple steps. First, choose the index. I've already named 3 stock market indices earlier in this video. There are a lot more. Second, pick the specific index funds you are interested in for that index. For every index, you are going to find lots of different funds that mirror that particular index. Third, do some research and compare the expense ratios for different index funds. Most brokerage accounts have this research function. There are many great index funds with expense ratios of 0.03% or less. If the expense ratio is higher than that, you might want to consider a different fund to buy, and that would be a personal tip of mine. Fourth and last step is to make your pick and start investing. For those of you who might be new to investing, I think I'll make a video later on different brokerage firms such as Vanguard or Fidelity that you can open an account with to buy funds. Anyway, we've come to the end of my video on investing, and I really hope that this information will be helpful and useful to some of you.